This war might look like a military conflict, but for investors, it is also a financial story. Because behind the headlines, there are several things happening in the global economy that many investors are not even noticing. And some of those things can quietly influence the oil price, markets, and even inflation. Whenever geopolitical conflicts appear, investors usually focus on the obvious things: missiles, military action, political tension. But markets often react to deeper economic mechanisms that are less visible. In this video, we will look at several hidden financial mechanisms behind this war, from energy routes and shipping risk to currency movement and commodity markets. And once you understand these mechanisms, you will see why investors watch the geopolitical conflicts very carefully. One of the most important things investors watch during this conflict is global energy supply routes. Large amounts of the world oil move through narrow shipping passages in the Middle East. If the tensions rise near these routes, energy markets begin reacting quickly. Even the possibility of disruption can push the oil prices higher. And when oil prices move sharply, inflation risk begin appearing in many economies. But oil is only one part of the financial story. During geopolitical conflicts, shipping companies face the increased risk. Tankers and cargo vessels traveling through conflict zones often require war risk insurance. When insurance cost rises, transportation cost increase, and higher transportation cost eventually influence the global trade and product prices. This is one reason geopolitical tensions can slowly influence the inflation worldwide. But markets often react even before these costs appear in the real economy. Currency markets are often the first financial markets to react during the geopolitical tension. Investors sometimes move money into currencies that are considered safer. These capital movements can influence the exchange rate across the world, and currency movements often affect inflation, trade balance, and capital flows. But currencies are not the only financial assets reacting. During periods of uncertainty, commodity markets often experience increased volatility. Oil, gold, natural gas, agriculture commodities. Investors sometimes move money into commodities because they are seen as hedges against the geopolitical risk. Now, this can create sudden price movements across multiple commodity markets. But the reaction does not stop in commodity markets. Certain sectors sometimes benefit during the geopolitical conflict. Defense companies may see increased government spending. Energy companies may benefit if the oil price rise. At the same time, sectors dependent on stable supply chains may face the pressure. Understanding these sector reactions help the investors to interpret the market movements more clearly. But the biggest impact of geopolitical conflicts is often psychological. Markets are influenced not only by economic fundamentals but also by investor sentiment. Geopolitical uncertainty can increase the risk perception. When investors become cautious, markets may experience volatility even before the economic data changes. But experienced investors understand something important. Not every geopolitical conflict becomes a long term economic crisis. Financial markets are deeply connected to the global events. Energy routes, shipping risk, commodity price, and capital flows all interact with the geopolitical development. Understanding these hidden mechanisms help the investors interpret the market reactions more calmly. So, the next time geopolitical news appears in the headlines, remember that behind the conflict, there are also financial mechanisms influencing the market. And if you want to understand how global events shape the financial market, subscribe to this channel because here we decode how the world moves with money.